Welcome to our short presentation on understanding the S Corp. One of the most important tax planning strategies has to do with making sure that your entity is the right one for your situation. The most common entity to form when you're starting your business is the LLC. In this presentation, we are going to explain how making an election to have your LLC taxed as an S corporation changes and often significantly improves your tax situation. Let's begin by briefly discussing Social Security and Medicare taxes. Social Security and Medicare are a tax imposed on working individuals. Meant to be the safety net of society, the government's intention was to raise funds in order to take care of us after we retire and have failing health. Whether you feel good about the government's intention or not, the reality is that this ends up being one of the largest taxes we pay as Americans. Social Security is about 12%, and Medicare is about 3%, making this total a tax of approximately 15%. As an employee of a company, your employer is required to withhold this tax from you. The employer is also required to pay half of the tax for you. So, as an employee, this tax is technically about 7.5% of your wage. The self-employment tax is the government's way of collecting these same Social Security and Medicare taxes. However, because you are self-employed, there is no employer withholding it from your paycheck, nor is there anyone besides you paying for it. So, you're stuck with the full 15%. And when this extra tax comes as a surprise at the end of the new entrepreneur's first year in business, it can be devastating. Now that we've established an understanding of self-employment taxes, let's take a look at how you typically get paid as an owner of a business and how that affects your taxes. LLCs are either owned by one person or by multiple people. Amazing, right? You thought you'd only be learning about taxes. As an LLC, you're typically pulling out an owner's draw. It can also be called a guaranteed payment, but either way, you're essentially just transferring money out of the business into your personal account. These payments are all subject to Social Security and Medicare taxes, aka self-employment taxes, in addition to the regular income taxes. However, as an S Corp owner, there are two different ways that you receive reasonable compensation from your business. The S Corporation requires you, the owner-officer of the business, to be an actual employee. This means you have to pull out a regular payroll from the company and withhold and pay all of the Social Security and Medicare taxes that an employer does. So, if an owner of an S Corp takes money out of the S Corporation as a wage, that wage is subject to that Social Security and Medicare tax. However, the secret about S corporations is that you don't have to take all of your compensation out as payroll. You are also able to take out owner's distributions. These distributions are taken just like a draw and are not subject to that extra 15% Social Security and Medicare tax. Therein lies the opportunity to save taxes. Let's run some numbers and see this play out. We've got our single member LLC here, with the owner drawing all of the money out of the company as profits, a draw. As regular LLC owners, you are not allowed to be an employee. So if you are an owner of an LLC that has not made the S Corp election, you cannot take any payroll out of the company and are required to take all of your profits out as owner's distributions or draws. So all of the funds, therefore, are subject to the 15% self-employment tax, as well as the regular income taxes, which are commonly around 15%, plus or minus. That makes a total of a 30% tax burden. That is painful. In the scenario where this business is generating $50,000 of profits, The poor entrepreneur is looking at a $15,000 tax bill. That just makes business not fun anymore. Now let's look at an S Corp scenario where the owner is pulling out half of their compensation as a wage and half as owner's distributions. The payroll portion is going to have those same income and self-employment taxes applied to it, the full 30%. But the owner's distribution is only going to be subject to income taxes, the 15%. So in effect, we avoided paying that extra self-employment tax on half of our income. How significant is that? Let's look at the numbers again. With the same total compensation of $50,000, we end up with a total tax bill of $11,325. That's almost $4,000 in savings. That is significant. Now, I've simplified the process and glossed over a few details, but the tax savings are real. We do really see these types of savings every day here at Mazuma. Now, the catch to all this is that you are required to run payroll, which I highly recommend hiring out due to the regulatory requirements. You've got to come up with what a reasonable wage means in your business. Getting consultation on that is also very valuable. And the S Corp structure requires you to file a separate tax return for the business. All of these services do cost you a bit more. However, the increase in fees is not likely to be greater than the savings in tax, especially with Mazuma's affordable fees. Typically for these services, you're paying less than $1,000 more per year and often saving at least $3,000 to $4,000. I hope this illustration was helpful to you. Please reach out to Mazuma with any questions you may have. Thank you.